Welcome to Growth Investing Mastery. Today is going to be our first strategy video, and we're going to be talking about selecting a growth stock. I've tried to boil my strategy down to something as simple as possible, and what I've come up with is numbers and narrative. We could call that NN. And typically what we mean by numbers is something objective, and this is often what the chief financial officer is reporting. So they'll be reporting things like revenue and earnings, EBITDA, and they usually compare in year over year and quarter over quarter numbers. Sometimes quarter over quarter is called sequential numbers. And the reason they want to report both year over year and quarter over quarter is to rule out seasonality and see how seasonality affects. So a lot of times this company will have a strong Q4 because they sell into the holiday season. So it's important to compare Q4 to Q4 or the previous year. But a lot of times we can also compare Q3 to Q4, especially in a business which doesn't have a lot of seasonality. And then the term narrative is really subjective. And that's what the CEO is often talking about. This is the story of the company, and we want something really positive, and we want to see details of accelerations in the business. And I put numbers first in the acronym NN. Generally, we want to look at the numbers first before the story of a company. And that's simply because it speeds up our process. We can rule out a lot of companies which have poor numbers. Let's define what we mean by numbers a bit more. So there's two basic questions we want to know for every company. And the first is how much did the company sell, typically called revenue. And the next is how much did a company earn. And there's a lot of different ways to define what a company earned. Primarily, we're looking for accelerations in the business, and the more geometric those accelerations, the better. So I've got two examples here of different growth patterns. One's a very strong growth pattern, and one's an average growth pattern. So the strong growth pattern, this could be revenue or this could be net income, but the strong growth pattern, it goes from 100 million to 105 to 116 to 140 and then to 180. And so going from 100 million of revenue to 105 million of revenue, that's just a 5% increase. But when we look at the latest quarter, it's going from 140 million to 180 million. That's a much bigger percentage increase. So we can see something in this business is accelerating. It's likely corresponding to a new product or something or a new initiative. And that's really when we want to dive in. We've kind of validated some of these numbers look good. That's when we can dive into the narrative after that. And when we look at a more average growth pattern, this goes from 100 million to 120 to 140 to 160 and then to 180. And this is adding a net new amount of revenue each quarter of 20 million. So it's pretty much static, the amount they're adding. And a lot of times this type of business, they could be spending on sales and marketing each quarter. And that's kind of boosting and getting an extra 20 million net new. But they might not have that kind of stunning new product or that initiative, which is really taking off. Let's talk about what the term revenue or sales mean. And this is one of the most simple terms in finance. Revenue and sales are interchangeable. So if you hear sales, you hear revenue, they're exactly the same thing. And it's a universally agreed upon definition. And it can even be explained very simply by analogy of a lemonade stand, where you're selling 10 cups of lemonade. Each cup costs $1 a piece. This business has revenue of $10. In contrast to revenue, earnings can be measured in a variety of different ways, and this often leads to investor confusion. There's just so many different ways profitability of a business can be measured, and 5 of the main ones that I see a lot are net income, earnings per share, EBITDA, operating cash flow, and free cash flow. And then to add to that variety, each of those metrics above can be measured in adjusted or GAAP, which is generally accepted accounting principles. And adjusted usually means they factor out stock-based compensation. So especially a lot of tech companies, they're paying in stock as a portion of their pay package. And the adjusted numbers typically factor out stock-based comp, and they might factor out other things depending on the industry. Because there's so many different metrics, I think this often leads to investor confusion. So what happens is somebody who's newer, they'll look up the definition of operating cash flow or free cash flow, and it's like, this complicated formula of take the net income and then do this and that, and then it's just kind of, well, which of these numbers do I want to look at? Which is these is important, and then what about cash or debt on the balance sheet? So there's so much to kind of look at here, and there's a long-standing debate on which of these metrics is best. So net income is the legal amount that shareholders are entitled to. Earnings per share is just that same amount per share, and then EBITDA is factoring out things like taxes and amortization, which is a complicated way of saying some of their assets might lose some value. The cash flow metrics measure the liquidity of a business, but on the next slide, we'll detail which ones I like. The earnings or profitability metrics that I like to use are net income and EBITDA. And this allows for really easy apples to apples comparisons between companies. So a company might report they have 15 million of EBITDA and 10 million of net income. And then this is really easy to take that number and see how this business compares to another business. Most growth companies, they'll report in net income or EBITDA. It's probably maybe 60% report net income, the other 40% report EBITDA. And this kind of shows that different CEOs in different industries, they may value one of the ways to measure over the other. And I like the combination of using net income and EBITDA and not picking kind of a winner there, because they do measure different things, and it's very hard to fake getting both of those right. To have positive net income, positive EBITDA, it means typically the business is definitely profitable. And earnings per share and cash flow require more manual calculations, which I wrote slows our process. So for earnings per share, you need to know the number of shares or the market cap to figure out that. So if I tell you a company earned 13 cents per share, you don't really know enough to know, is that $20 million of revenue? Is that $200 million of revenue? Or you don't really know what that is, and you have to look that up. So I don't want stuff that I need to look up. And cash flow also requires this more manual process typically. A lot of companies which aren't profitable yet, they'll report cash flow numbers because they want to demonstrate that liquidity to investors. They want to show this business can survive on its own, even if we are GAAP negative. And then there's a long-standing debate about whether to use adjusted or GAAP numbers. And you can really use either, but you don't want to mix and match. So you don't want to compare an adjusted number to a GAAP number. Let's say you were looking at adjusted Q3 earnings per share, but then you compare that to GAAP Q4 earnings per share. Those numbers aren't going to be apples to apples, and you're going to get a false impression. And maybe when the market in 2020 or 2021, the market was really valuing adjusted numbers for companies, especially in the SaaS space. They would typically really only care about what they reported on the adjusted side. And then after interest rates rose, I noticed the market was maybe, especially in 2023, was rewarding companies for reaching GAAP profitability. And I saw a couple companies go up over 100% when they reached GAAP profitability in 23 and 24. But lately, the market's switched back to being more mixed. It's looking at both adjusted and GAAP numbers, I think. So the market does kind of go in waves for which it prefers here. I don't factor that part too much into the strategy, but I just want to make sure we don't mix and match them. Let's take a look at company specific metrics as we define what numbers means more. So in each press release of an earnings report, the company will track what it considers important. And if the company considers important, it's also important for us to follow that. So many of these will be industry specific. So in social media, they'll often track DAUs and MAUs, which are daily average users and monthly average users. And then there's a term ARPU, average revenue per user. So that's something you would see with a Reddit or a Meta reporting. And then SaaS-based or software companies, they track net retention revenue and things like customers who spend $100,000 annually. If they're a smaller company, they might track customers spending $50,000 annually, or if they're a bigger SaaS company, they're tracking 1 million spend plus annually. And you want to look at the year over year and quarter over quarter numbers for those as well. And then companies in different industries, I use shipping as an example. Shipping is probably not an industry I would look to invest in, but a shipping company may measure net tons shipped. And we really want to see how that compares to the previous quarters and previous years. Let's talk about some strong quarterly numbers, or what we'd really be looking for in a company. And I've made up some numbers here for a hypothetical company where if I saw these numbers off of the bat, I would definitely be interested in learning about the narrative. So we've got revenue of 300 million, which is up 55% year over year and 16% quarter over quarter. So I usually look for companies which have over 40% year over year growth in revenue. And that's a pretty strong number. And it's going up quarter over quarter, which is encouraging as well. And then if we look at EBITDA, EBITDA was 35 million. And EBITDA and net income, they're always going to be lower than revenue because revenue is just the sales, and then EBITDA and net income are how much they're making, right? So we see that EBITDA was up 80% year over year and 22% quarter over quarter. That means that the earnings are growing faster than revenue. So that's nice as sales are increasing. The product is also getting more profitable. And then likewise, net income's usually lower than EBITDA. We see net income's up 72% year over year, 19% quarter over quarter. So usually those are going to line up with EBITDA. Sometimes there might be differences if there's tax issues on a given quarter. And another useful metric is gross margin, which shows the profitability of the individual product, kind of when you factor out sales and marketing and research development and HR type stuff. Here we see the gross margin was 78.5%. And the important part is that it's up 80 basis points quarter over quarter. And basis points is just a fancy way of saying 1/100th of a percentage point. So 80 basis points means it went up 0.8 on the way that they measure gross margin. And we see that the gross margin is also up 300 basis points year over year. So that means that a year ago it was 75.5 and now gross margin is 78.5. This likely means the business found some extra efficiencies. And one caution is you can see sometimes gross margin go down as a company scales up. They might be offering better deals to customers. So it's not always a red flag if gross margin goes down, but it's definitely something to keep an eye on. And lastly, I have a company specific metric, which is widgets per minute is up 115% year over year. And I intentionally use something that doesn't really make sense of widget per minute, but we want to find those company specific metrics and see what they're measuring. We want to know what the business finds important. And if the business finds it important, we should find it important as well. Let's talk about the term narrative, which is really the story of the company. And previously, we were looking at numbers, which was objective, but the narrative is always going to be subjective. And one of the advantages we have right now is it's very hard for an AI to know what the narrative of a company is or know if the narrative is strong. Let's talk about what makes a strong narrative for an earnings call. One of the main things we want to see is a lot of enthusiasm from management on the last earnings call. And we want to see direct language of success on the results from the CEO. So sometimes the CEO will be point blank. And I gave an example here of a CEO saying we had an excellent quarter, surpassing all our internal metrics. So if the company says they surpassed their internal metrics, that's often a very bullish sign. And a lot of times in the question and answer session at the end of the earnings call, analysts will be offering congrats. So let's say congrats on the strong results, and they all like to kind of chime in with their congrats. And a couple times you may see analysts be incredulous of the results. This is a very bullish sign when they'll say something like, you outperformed all our internal models and things like this. We also want to be cautious of an undisciplined CEO overindulging. And this means during the CEO's prepared remarks, they haven't really prepared. They're kind of just winging it. And you can see this in the transcript when they kind of go into this stream of consciousness or they get off track. Usually you want to see a CEO who's, you can sometimes even hear them reading from their script. But you want them to have real prepared remarks where they're thinking carefully and thoughtfully about what they're saying. You also want to be cautious of what I call a one-man show CEO. And this is where the CEO takes over the whole call. There's basically no CFO, and the CEO is the one reporting financial metrics. It's very hard for a CEO to do the role of the entire C-suite or all the other executives. And we want to be really careful we're not dealing with someone who's kind of like got used car salesman vibe, let's call it. or something like this, or they're just kind of a charlatan or overly charismatic. What we really want to see is a dynamic duo. So we want to see a CEO and a CFO who are both pretty sharp. And a lot of times they'll counterplay versus each other. And they should know on the question and answer session who's going to take the question. I'll give an example of NVIDIA. So if an analyst asks, how do you see the data center build going out in 2030? That's really going to be a question for the CEO, Jensen, who's going to say, like our engineers are doing amazing work and here's how the future looks. And if an analyst goes, I saw gross margin tick down 250 basis points this quarter. Can you give me an idea of what's going on there? And then that's where the CFO would come in and say the product mix was a bit different, or, we had, were different factors of what we shipped this quarter impacted that. Let's talk about some examples of positive narratives and the language of earnings that we're looking for. We've got an example here of the AppLovin CEO saying there's a long, long line out the door. And that was in regards to their new e-commerce pilot. And it's a type of comment which is really hard to quantify. Notice there's no numbers. It's not the line increased 50% year over year, right? It's just all subjective, but you do find sometimes gems like this in the earnings call where they will really say how well or how poorly something is doing. And the Stera Labs CEO in 2025, they said, we are shipping to all hyperscalers across multiple different product sets that we have. So there should not be any doubt or question about that. And here you have a CEO going on the offense a little bit. There shouldn't be any doubt or question, right? We're shipping to all hyperscalers. And I like to see when the CEO is pretty clear. He uses the word all and not most hyperscalers. So there's maybe considered 8 to 10 hyperscalers right now. And he wants to be clear that they're shipping to a lot of different customers. And here we have the Reddit CEO saying, we feel very good about the pace we're on in Q1. So this is very direct. And they were reporting Q4 numbers when they said this. And this is a very fine line the CEO has taken because they're not supposed to be pre-reporting Q1 numbers. But he is saying that they like the pace they're on in Q1, or it's very good. So that's kind of hinting that Q1 is going to be a pretty strong quarter. And that may give us some reassurance as an investor to boost our confidence in the stock. The next example is the Paymentus CEO. And he just said point blank, we had a phenomenal third quarter. Usually you'll see a CEO say we had a good third quarter, a strong third quarter, excellent third quarter. But sometimes you'll see them use a term like we had a groundbreaking, phenomenal quarter, or they'll use a word that's over the top. And that's actually pretty good too, because it shows how strong this quarter was. They're stretching for finding a word such as phenomenal. And lastly, we have a new company I'm getting into, which is Cineverse CEO. They said this was the strongest quarter in the company's history. And that company's been public since the early 2000s. So if you think about it, that means they've reported maybe about like 80 or 90 earnings calls since that time. And this is the strongest quarter out of those 80 or 90. So that's always a good thing to hear. And by the time we're done reading the transcript for our earnings call, we want to have the sense that we really want to buy shares or get in. And that's important for us to have enthusiasm and optimism around the business based off the narrative. Let's talk about when we'll sell on a narrative change for the worse. So here's a recent example of the company Credo, which I sold yesterday. And I was looking back at the Q3 to see what did I find so encouraging here around the narrative. Well, in Q3, the Credo CEO said, I'm pleased to share this turning point has arrived, and we are seeing even greater momentum than initially projected. So that's really strong language. We see the turning point has arrived. So this business is really starting to accelerate, he's saying. And we're seeing greater momentum than initially projected. So they had their own internal metrics and they surpassed them. And that's always a nice sign as well. Then we have an exchange in the Q&A section of the transcript. The analyst on Credo says, obviously, you're guiding to a level that's well above what most of us had in our models. And the CEO replied, really, in the last 90 days, we've seen a couple of projects come together and even stronger, with a stronger forecast than we expected. And a couple comments here. When the analyst says obviously, it means it's the elephant in the room. All the analysts notice they beat every metric, everything on guidance was well above what anybody thought was even possible. And you can kind of see the CEO is stumbling over his words a bit here with all those commas in the transcript and the dash. Sometimes when the company outperforms, the CEO is a little bit cautious and on what they're going to say because they don't want to forecast too strong a trend and say like, we're doing even better than I thought was possible. Then it's like, well, why didn't you know the business was doing that well? So that might be why they kind of have trouble enunciating what they want to say. And then when Credo reported Q4, they had this huge reveal in the report that a single customer makes up almost all the revenue. So Amazon was 86% of revenue in the quarter, which is absolutely shocking because on the previous earnings report, they had said that they have 7 customers who make up more than 5% of revenue. And one of the analysts ran the numbers and said, it looks like your customers outside of Amazon are basically collapsing, or they went from something like 48 million, I think, to 19 million in the quarter. Um, and my original thesis and narrative around Credo was that they were selling to a lot of different customers, the broad diversity of customers. And while the CEO kept assuring investors that they're going to diversify revenue, and then in the coming quarters it's going to be much more diverse, and this was kind of a one-off. Um, the fact that the business went down outside of Amazon made me worry that Credo could be losing to competitors, and it also left me wondering why those other businesses aren't continuing with Credo. Let's talk about some more general guidelines on when to sell a growth company. When the numbers or narrative change for the worse is often a good sign to sell a company. And I put or in capitals here. So it's really either or changes. If the narrative gets worse or numbers get worse, we want to sell typically. And a lot of times, what'll happen is an investor will really love the narrative of a company. It's got a great story. It's a growing company. Maybe you even use the product, but the numbers worsen for some reason. And I used to make the mistake of just bunkering down and holding that company no matter what they reported. But a lot of times, it's going to be better to sell or trim if the numbers get worse. And I wrote, never give a company a free pass with poor results. So that's a key concept as well. A lot of times a company will have a bad report, and that's a good reason to sell. I'll give one example of poor numbers where it might not be that obvious at initial why it's so poor. The company guided for 50% year over year revenue growth, but their actual landed at 40% year over year. So a company getting 40% year over year revenue growth is pretty good. So we might be tempted to think, okay, well, they got 40%. That's still pretty strong. But if the company guided for 50% revenue growth, it's actually a pretty big miss. And I wrote here, metrics no longer accelerating is a logical reason to sell. And I'm using logical, it goes back to that objective part of the numbers. So if the numbers were showing a clear acceleration and then all of a sudden in a quarter, that acceleration no longer exists, it's a good reason to reevaluate. And it could mean trimming, it could mean selling. But if the company has a reasonable excuse in their narrative of why this quarter was bad, maybe, and that things are back on track, we might tend to believe them, but we want to be really cautious about that. And an example of a poor narrative is when a CEO says they're cautious about the upcoming quarter. They might not use the word cautious. That might be too extreme for them to say that because they don't want to put in something too pessimistic. But we can often see some hints that the upcoming quarter is not going to be that great by base off what they're saying. And we want to avoid companies which have pessimistic and blaming language, which can be a real red flag. One example I remember from a long time ago is the Slack CEO. This is around 2020. He got really upset that Microsoft Teams was even a product, and they were threatening lawsuits against Microsoft. And I remember the CEO just was so frustrated, so angry about we won't stand for this. We know our values, and it was is you could see the CEO was becoming kind of unhinged, and somewhat predictably, maybe Salesforce bought out Slack as that was really the quarter I think where the CEO realized this business can't continue on its own. And another example was Celsius earnings drink. They had a number of very strong quarters in a row. And then all of a sudden they got hit by inventory issues where Pepsi was managing their inventory. And the entire transcript was nearly about inventories and discussion of inventories. Previously, I don't even remember them talking about inventories. So when the narrative just flips upside down like that, that can be a strong reason to sell. Let's talk about one more important concept on narrative, which are secular tailwinds. We really want to see the industry that we're investing in growing. And one example, which everybody knows about right now, is AI, which has a clear tailwind. But previously, there was some other tailwinds in the markets. Cloud and SaaS was a popular one, especially from the time frame of about 2010 to 2021. Social media was another big investing concept, let's say. Meta went or Facebook went public in 2012, along with LinkedIn and Google Plus. Twitter was public, Pinterest. And looking back, even once a couple cycles before that, we had the 2000s internet, and that was a very, very strong trend as well. And we want to be cautious around investing in highly secular industries such as real estate, mining, or insurance. And actually, mining could mean mining gold or cryptocurrency, even. It's just in general something which is subject to boom and bust cycles. And we want to show some care around secular trends that are driven by regulations. The example I gave is solar. And I used to invest in this company called Nextracker, which made a key component of solar panels, allowing them to tilt towards the sun. And I noticed that this company began trading on political news. And I realized that a lot of the benefit the company was getting was from regulations. And a lot of times regulations are a binary yes or no type of event. And that's kind of not something we want to have impact our business if possible. And we prefer proven tailwinds over futuristic predictions. And what this means is with AI right now, let's say, we know the trends are strong. We know what the spend is. But if we're talking about another thing, let's say virtual reality goggles, and somebody says, in 2035, we're going to have these crazy VR goggles. Well, we can't really invest off that futuristic prediction just yet. We need some numbers and some backing for that company. Now let's summarize the numbers and narrative approach. Having accelerating financials and a strong story are both essential. And we really want to see a dynamic CEO and CFO combination where each of these executives can hold their own weight. We look for accelerating revenue, net income, and EBITDA. And we want to find a compelling narrative, something that draws us in or makes us think this is the next big idea. We want to confirm secular tailwinds and see an industry trend. So that means the industry is growing overall. And we should definitely be optimistic about our investment. And that's an important part. That'll help us build confidence in our investment going forward. We want to sell when the numbers stop accelerating or the story has worsened. And one last point is between the objective and subjective. This is really the duality or some contradictions in investing. We need to sometimes be objective and sometimes be subjective. And it's important to make that differentiation. Finally, I wanted to talk about where this channel, Growth Investing Mastery, is headed. I'm planning to do a number of upcoming videos, and this is always going to include a portfolio review at the end of the month where I'll review my allocations and what I'm investing in. I might start adding some things like watch lists and things like that. And I'm planning to do a bunch of company deep dives, especially on companies I own or companies I just started investing in. And there's going to be more strategy videos as well. This was really the first strategy videos. I have a number of concepts in mind for how these could go, but definitely subscribe and leave a comment. Any feedback is going to be helpful. Thanks.